it can literally still go up by my math over 100 times from here. Well, you own 1% of something that goes up 100 times. You've doubled the size of your portfolio with a 1% allocation. Given that I'm a credit guy, okay, I have to understand the world that I've grown up in. And credit is all about hedging your risks. And so insurance to a credit guy means a whole lot different things than to your average investor, okay? And insurance can be a large part of your portfolio. It's not like just owning house insurance is a portion of your portfolio. As a credit guy, you could have 50% of your portfolio in insurance, okay? That's not unheard of. And in fact, the guys that did the best during the financial crisis in 2008, 2009, had 90% of their portfolio in insurance, meaning they had bought insurance on the explosion of the subprime mortgage crisis, for example. But taking a step back, and I want your listeners to understand, I describe Bitcoin as insurance predominantly to my credit peers, okay, because it means something different. But to the average investor then, and this is why I will refine my pitch a little, yes, it is insurance if I'm trying to get you off of zero. If I go between 0 and 5%, which is what I try to get them to move to before they go down the rabbit hole, like people inevitably do, like you do, 5% is still an insurance policy, okay? And it's important for them to own that insurance, because if they don't own that insurance, they will suffer the consequences if the inevitable happens, when the inevitable happens, I should say. So for people that have taken the dive down the rabbit hole, like you and look, I'm way higher than 5%, but I'm not 100%. I need you to understand that. I don't think you're 100% either. But if I'm 40%, yes, that's higher than the traditional portfolio mix for a traditional investor. But for a credit guy like myself, that's fine. It's still insurance in my mind. If it hurts, then you might own too much. And that's why, again, like, you shouldn't care if it's 5% of your portfolio and, oh gosh, it's gone down by 20%. So, wow, I'm off 1% across my whole portfolio, right? That's not a bad thing. But when you own 80% of it in your portfolio and it goes down 20%, you've lost 16% of your whole portfolio because you're so highly exposed, right? So perhaps sometimes when it hurts too much, maybe that's an indication that maybe you own a bit too much. And that's what's beautiful about Bitcoin, is because my argument to everybody is you don't have to own a lot of it to participate in the asymmetry of the upside opportunity, okay? It can literally still go up by my math over 100 times from here. Well, you own 1% of something that goes up 100 times. You've doubled the size of your portfolio with a 1% allocation. Well, you need to know that my price target is 2 million and it's in today's dollars. Okay, today. So my price target is 2 million in today's dollars, which means if it gets there in 10 years, it's 10 million in 10 years, because 2 million of today's dollars will be 10 million in 10 years dollars. It's not quite that much of debasement in currency, but the point is measured in today's dollars. So if it's $1 million in today's dollars, that's your price target. And by the way, Fidelity, which is a very well-respected U.S. money asset manager, as you know, top 4 in the world, their price target is $1 million by 2030. So we're talking real numbers here, and there is the asymmetry of the upside. So when I say 2 million in today's dollars, yeah, man, that's way higher 10 years from now. It is an insurance policy with no expiry. There's no counterparty risk. There's no theta, meaning there's no time expiry on this. And that's the beautiful thing about Bitcoin. I like to say, let's talk in 20 years. If my price target is 2 million in today's dollars, and I tell people, don't buy it at 30 because it's going to go to 15,000, but it doesn't, Who's the idiot? Because
Right.
the upside's 2 million. And you're going to get so fancy that you're going to wait for it to go down by a de minimis amount in terms of the big picture, that you're going to wait, and the chance that it doesn't go to that price target could end up costing you your future. So you don't mess with stuff like that. These are rounding error prices. And I'll put a cherry on top, I hope. I got involved in Bitcoin in 2016, okay? It was under $1,000 a Bitcoin. I bought a bunch, but I honestly believe that Bitcoin is a better investment today at its current trading price than it was when I first got involved in under $1,000. And the simple reason for that is the response to COVID by governments, by global governments, okay? From my experience, is anything bond related, okay? Bonds are the worst investment profile I have ever seen in my 35 years of managing bond risk, okay? So start by what they should not own, which is to say that if they're looking for a bucket to take exposure out of to invest in Bitcoin, the logical place to start is a bond bucket. So be careful. If you are planning for Armageddon, you're not able to pick up your house and move it across borders like you are with Bitcoin, all right? And then I actually own gold and silver and commodities and these other things that are hard asset related. And it's because that's the way I've always managed risk. And I get in trouble with some Bitcoin maxis who say, well, if you're so convinced, why aren't you all in? And there's two answers to that. One, I've never managed risk that way because while I am certain that fiat will debase, I'm not 100% certain of my price target on Bitcoin. I can't be. But what I can be is enough exposed to that price target that I participate in the upside regardless. My 40% exposure, I'll be just fine if Bitcoin realizes my $2 million price target, right? Come on. I don't care what happens to the rest of my portfolio. Bitcoin will have been the outsized gainer that it should be. So I've never managed risk by being all in on one trade. And then the second part is I don't have to be. That's the beautiful nature of the asymmetry of Bitcoin. So if my price target for Bitcoin is $2 million in today's dollars, and I'm not 100% certain it's going there, right? Because you can't be. But let's say it's a binary outcome. It's either the right-hand side tail or the left-hand side, when in reality, it's a probability distribution, much shaped like a bell curve. Let's say there's only two outcomes, binary, okay? The market is telling me right now, and I'm going to base this on a $40,000 Bitcoin price, not $30,000. If my price target is 2 million in today's dollars and it's trading at 40,000, that's 1 in 50, right? That's a 1 in 50 chance. And the 1 in 50 chance is 40,000 divided by 2 million. That's 2%. I said I wasn't 100% certain, but dude, I am so much higher than 2% certain. Don't even mess with that shit, all right? Just put it on your books, because 2% is like going to the Kentucky Derby where there was 80-1 odds against that horse winning. And guess what? The horse won the Kentucky Derby.